Let's talk about SoFi, shall we? Let's talk about the current situation of the company, especially after the latest earnings report. Usually what do we get? We get a triple beat, stock goes up 10%, maybe even more on the day, and then in the following days the stock drops back down. This time we also had beats across the board, but the stock did not have the usual pop. The exact opposite happened. We went down, and suddenly the whole sentiment changed, right? Because only when the stock goes up on positive results does that mean that you as a long-term investor are expected to be bullish. But when there is a beat across the board but the stock reacts negatively, then suddenly sentiment changes and the thesis is broken. It's quite a strange way to think about it, right? Which again doesn't make any sense. The quarter was a good one. The company is growing, it's going to the right and up. What else can you ask? Well, the only thing we're asking is, of course, something from the stock market, because the stock is not really moving much. But let's be honest, as long-term investors, yes, it's true at the end of the day, we're all here to make money. But also, we're here to build up our position to get as many shares as possible of a great company. And if I can buy more and more shares for a cheaper price, what's the issue? There is no issue. For long-term investors, there is no issue. For short-term investors, there is an issue because you're getting into that position to make a quick buck, right? And if you're not succeeding in that, opportunity cost, you lost the opportunity here to make some money quickly. Okay, I get it. For traders, maybe it's not great. But other than that, I mean, instead of just looking at the ticker symbol, instead of just looking at the stock price, have a look at the business. We're going to do that in this video. Of course, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, would really appreciate that. 900 subscribers away from 40,000, so thank you very much for all the support. And if you want to support me even further, do check out the link down in the description and in the pinned comment to get a top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So let's start with a major overview here, right? Of course, we already covered SoFi's earnings report a couple of days ago. If you want to watch that, it's going to be in the top right corner. But overall, I mean, what's bad about this? This is a company that has grown revenue over 25% year over year for 12 consecutive quarters. Quarterly adjusted EBITDA continues to go up. Yes, it is true that in Q1 it is down a little bit. Q4 was really a one-time outperformance. But overall, I mean, can you complain about that? EBITDA margin continues to go up as well. Then what do we get here? Wrote down a couple of points for the overall, let's say, performance and notes that were mentioned during the earnings call. Revenue guide has been raised. They assume still negative 6.5 year-over-year growth in lending and 20% year-over-year growth in tech platform. They still expect over 2.3 million new members in 2024. Yes, it's true that Q2 guide was a bit light. And last one here, SoFi's total capital ratio improved from 15.3% to 17.3% quarter over quarter. Then with regards to macro uncertainty, especially with regards to the lending segment, so these were the comments. I would say our outlook for the lending business is more reflective of uncertainty as opposed to whether or not there are great trends. Taking a conservative stance gives us the most optionality to do more, but not necessarily to have to do less. By the way, they also sold $1.9 billion of loan during the quarter. So this is again them putting the bar low so that they can outperform, especially in a uncertain macro environment. Remember, last year we expected 6 rate cuts in 2024. Now the expectations are between 1 and 3 max. So they are adjusting accordingly. But as we've seen in the last year, or actually last couple of years, this company usually guides quite conservatively and then beats and raises each and every quarter. With regards to the technology platform, so as we've seen, yes, year over year, it's up 21%. $94.4 million for the quarter was net revenue. It is down quarter over quarter. There was a large bank deal in Latin America. Contribution profit was $30.7 million for the first quarter. That's an increase of 107% year over year for a margin of 33%. So that's great. There is although no news on the top 5 US bank. We definitely do not get as much information as we would like to with regards to the tech platform, Galileo, stuff like that. Hopefully that will change in the future. Then with regards to the financial services segment, revenue there increased 86% year over year. Contribution profit, of course, exploded year over year. They also said with regards to credit cards that they're investing more aggressively in 2024. This is a high return equity product, but there is a J curve, meaning you start slow, you go low, and then you explode. Then zooming out a little bit. I know the term zooming out might not be loved by everyone, but hey, look at members. Up and to the right. Look at Galileo accounts. Up and to the right. Yes, we did have some weakness here back in 2023, but now I do think that we're well back on track. Of course, like I said, I would love to get more information with regards to Galileo, more deep dives. Hopefully management could provide us with a bit more, maybe in the next coming quarters or maybe during conferences, remains to be seen. They also say here that Q2 is a seasonally weaker quarter for the technology platform business, but the year-over-year comparison is what counts. As for the guide for Q2, like I said, it was a bit light, so year-over-year growth of around 15%. Adjusted EBITDA of between $115 and $125 million with an adjusted EBITDA margin of around 21-22%. GAAP net income still positive, expected to be positive for the whole year, between $5 to $10 million. As for the full year guide, like I said, they raised it a little bit, so annual growth in net revenue between 15 to 17%. Previously, it was between 14 and 16%. Adjusted EBITDA margin still around 25%, but adjusted EBITDA did get a slight bump up. GAAP net income now between $165 and $175 million. That's up from $95 to $105 million, the prior guide, but that includes a gain of $59 million on extinguishment of debt in the first quarter of 2024. Diluted EPS now between 8 to 9 cents, previously 7 to 8 cents, and then tangible book value growth between $800 to $1 billion. That's up from $300 to $500 million in the previous quarter guidance. Then shall I remind you all what was mentioned 3 months ago during that earnings call? For the 2023 through 2026 time period, we see 20 to 25% compound annual revenue growth, assuming no meaningful change in the macro environment, which, by the way, their outlook for that was very, very pessimistic. I mean, no GDP growth, 5% unemployment rate, stuff like that. Continue here, no significant new business launches or acquisitions such as small, medium business checkings and savings, or small, medium business lending, a broader asset management business, insurance, a broader credit card portfolio, new technology verticals for the technology platform business, or new geographies. The 20 to 25% compound annual revenue growth from 2023 to 2026 assumes a compound analytic growth rate of 50% for financial services revenue, mid-20% for tech platform revenue, and mid-teens for the lending segment revenue. The earnings power associated with this growth is notable and could drive between 55 to 80 cents per share in GAAP EPS in 2026. Moreover, they see 20 to 25% EPS growth beyond 2026. So when you read all of that, when you see the results over and over again, when you hear the comments from management, when you see that track record during the pandemic, during a period where the majority of their business came from loans and how they performed and how they came out of that struggle, I mean, are you going to bet against that just because the stock hasn't moved much? I'm not going to do that. I think eventually the stock will follow the business. The business right now is doing exactly what it should. It's going up and to the right, and that's exactly what I like to see. It's a business that is growing revenue quite fast and in a profitable way. Yes, macro does play its part in such a business. Every time we talk about inflation, every time we talk about interest rates, it's going to affect this type of stocks. Probably every other fintech stock as well. Positive notes, positive comments from Jerome Powell, from the Fed, you're going to see green. Negative notes, you're going to see red. That's just short-term problems. Long-term, you want to see the business executing. Long-term, you want to see the business grow and in a profitable way. So far, I see no indication of them not achieving their own goals. Right now, if you look at the stock, pre-market stock is at around $7 or so. On the weekly, we are red. We are under the 20, the 50, and the 200-day moving average. RSI on the weekly is pretty neutral. We're now back in an area where previously we had found some bottom-ish at the end of 2023. So that's why I'm quite comfortable picking up some shares right there. So that's about it for me in this video. Of course, many will disagree, and that's fine. Nobody is forcing you to buy SoFi stock. Nobody is forcing you to invest in anything, right? This is my choice. This is your choice. Overall, I think positioning, of course, in your portfolio allocation is important. If you're starting small, 1-2% of your portfolio, and then increasing it accordingly is quite responsible. It's not a big part of my portfolio, but if it works out, then it might become definitely a much bigger part. So that will be it for this video. Of course, do share your thoughts down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.